Hello and welcome to our channel. If you've not visited here before, my name's Charles Delastic. I'm the Managing Director of Bluebond Tax Planning, and we've been helping clients eliminate inheritance tax for more than 18 years now. Now, a big part of dealing with inheritance tax and estate planning is setting up trusts for people, and this video is all about what is a trust and how does it work, generally speaking. So without further ado, let's get into this particular video after the intro. So what exactly is a trust? Let's start right at the beginning. It's a separate, S-E-P-R, separate legal entity. What do I mean by a separate legal entity? It exists separately in English law in the same way as each person, husband and wife, are treated separately for tax purposes. So it's a legal entity in its own right, which is the easiest way. But let's get into it. I'll explain that in a bit more depth. So trusts are all about retaining control of your assets while you're still alive and making sure that the right people have control, even if you choose not to have control. There are different types. You can write trusts into your will. I'm not a big believer in those. I prefer lifetime trusts, which are set up during lifetime, because generally you know what the rules are and unlikely to change retrospectively once a trust is set up and exists. If you think of a trust as a strong box, that might be a good way of thinking about it. So you get a box, you pay for the box to be set up, and the more complex and stronger the box is, the better the lawyers you need to make sure it's built and set up properly. So you pay for that in the first place, and then you put it in the right place. You can take assets, you can put them inside the box, and then the person who puts the assets into the box is called the settler, and then they lock the assets away and the trustees keep the keys. In other words, they have control of the assets, but the assets are there for the beneficiaries. Those are the people who actually own the assets inside the box. Yeah, so hopefully that makes sense. So again, it's about good lawyers. So how do you set up a trust? Good lawyers, absolutely essential, because the devil is always in the detail, if I've said that once. It's about making sure it's written out properly, and we use some of the best lawyers in the country, and ultimately they have huge professional indemnity insurance to make sure that their trusts are properly written up. So there are 4 parts to a trust, and here are the 4 parts. So the very first thing is the settler. They're the people that put the assets into the trust, and it may be on their death that the assets go into the trust, even though the trust is set up during lifetime. They're the trustees. Now, the settler can be a trustee during lifetime as well, but usually in ours, it's the settlers and their adult children who are the trustees, so they control the trust during lifetime. Then they're the beneficiaries. Those are the people who are usually the adult children, sometimes sometimes grandchildren, who are all beneficiaries of the trust, and sometimes with some of our trusts, even great-grandchildren. So the 4th part is a settlement. The settlement can be as little as £10, or it could be £325,000, right? So those are your 4 parts, but effectively, if you set up a trust within your will, and why we don't like them is because the settlement doesn't take place until a person dies, when their assets go into the trust, right? That is the settlement. So the trust doesn't actually exist until the person dies. So they're cheaper to set up that way, but ultimately you have to set up the trust. And then there's, but if you set it up with just £10, there are some major benefits. For instance, you can gift assets away during lifetime, and if you gift 325 into one of your lifetime trusts, and then you're never going to need the money again, it's actually better and better protected if you do it via a trust rather than giving the money directly to your children. And if you live 7 years, your allowance just switches back on again, and you've got the 325 to use again. So lifetime trusts, we believe, are better especially for people with big inheritance tax problems. Right, another way of thinking of a trust is, like I said, it's a separate legal entity. So most people understand what a limited company is. People can set up a limited company. So effectively somebody goes out, they go to their accountant, they put £100 in or whatever, and they set up a limited company and they own all the shares. So they set it up, they're the settlers of the limited company, except they're not really called that in a limited company. But where it does equate is the trustees relate to being directors of a limited company. In a limited company, directors control the company, right? The beneficiaries are like the shareholders. The shareholders own the shares of the company, so they're entitled to those assets. And the trustees, the directors of a small company, can also be the owners and the shareholders, and actually the people who settled it in the first place. So if you think of it in a similar way to a limited company, and limited companies are taxed differently and separately to individuals in the UK, and therefore that's why it's a very good analogy in the way that the thing works. So limited companies. So the one thing about trusts is that they are complex. They have complex rules, and especially on tax. So they have initial charges when you go in. You shouldn't put in more than 325, otherwise you get charged. You have something called a periodic charge, which is an income tax charge every 10 years. The capital gains tax charges are different. The tax rules are generally different around trusts than they are for people. So end result, always get good advice from an experienced practitioner to set up a trust. And I personally believe that lifetime trusts are better. There are different types of trusts which suit different people. And one of the things you can use is that a trust can, like a flexible reversionary trust, you can put money into that trust and get your capital back over a period of years. So you get the best of both worlds. If you don't want your capital back after 7 years, it's outside of your estate. But if you do want it back, you can get it back in any given year, or at least a proportion of it in any given year. So many different types of trusts. End result, always take advice on setting up trusts and make sure they're set up properly. Do not attempt to do this by yourself, because you will invariably get it wrong. Okay, that's trusts. That's what they are, more or less how they work. Hopefully you found that video helpful. If you did, give us a like down below. If you want to know more about inheritance tax, we've got a free guide to an ebook down below. There's a link, but also there's a much more comprehensive guide done in a series of videos, very much like this one, in that you can get from our website. So thank you very much for listening. As I say, hopefully you like that video, and we'll look forward to talking to you the next one. Thank you. Bye for now. Thank you.